Hi, everybody. I'm Elliot Began, and this is another episode of TIG Talks, the podcast taped in front of a live virtual audience, which is you. And as a reminder, it's all about your questions. So please use the Q&A icon at the bottom of your screen to type in any questions you have, and we'll try to tackle every one of them today. So joining me is my friend, Jessica Bates. I go to Jessica for all things debt financing. I do it for numerous reasons. One, she's just super cool. Two, she is so knowledgeable and is able to share that knowledge in a way that doesn't seem nearly as frightening or, fraught with all of the financial talk that many others interject in that conversation. And I think, now more than at any other time before, understanding all the choices that you have before you as a founder to finance your business and finance your growth is critical. So today, that's what we want to tackle. Nothing is off the table. The hard questions are totally cool. Jessica's going to give you the straight skinny on the good, the bad, and the ugly, the things that you have to be aware of. We'll talk about ABL, we'll talk about factoring, we'll talk about PO, we'll talk about venture debt. We'll talk about anything else that we feel like. And mostly we'll take your questions and want your feedback. So with that, I'm going to let Jessica introduce herself. So thanks so much for joining and doing this and being a part of it. So please tell us a little bit about yourself.
First and foremost, thanks, Elliot, for having me and for that super warm intro. I particularly liked when you called me cool, but appreciate all of it. So yeah, just to introduce myself. So my name is Jessica Bates. I'm with Dwight Funding. Dwight Funding provides working capital solutions, but specifically to growing consumer product brands. As such, we spend a lot of time in this space. We know the food and bev space very, very well. As I'm sure, certainly Elliot knows, and I'm sure many of the people watching know, it's a big industry, but a small community in this growth stage consumer space. So, I do my best to understand the various aspects of finance, the various aspects of debt, so I can do the best to be consultative to businesses that are growing and looking for some sort of funding solution, whether it's debt, whether it's equity, or even going further under the umbrella of debt, helping them find the right debt solution for their business as they scale. So I'll stop there initially. Great. and we'll take the dialogue from there.
Yeah, we're gonna jump into the fun stuff, right?
Let's do it.
So let me start with a really simple question, and it's probably not simple, so just FYI, so I'm just screwing with you. And the simple question is, why do people say that debt is less expensive in the long run than equity? Because
that's a great question.
Freaked out when they have to start paying interest and paying principal. Why is debt less expensive in the long run than equity?
It's a really good question. So there's a number of reasons. Equity, you are giving away a piece of your business. What may seem like a small piece today, if milestones are hit and the business builds truly the way that the founder expects it to and wants it to, whenever there is a liquidity event or an exit, that small percentage today could end up being a very large percentage of your business down the road or when that liquidity event happens. So that's one reason. Another reason is if a company, I'm going to give you an example to explain this next reason. If a company had to raise today in this environment of COVID, maybe they have felt some challenges or experienced some challenges during this pandemic period. If they were to raise today, they may not get the valuation that they would have pre-COVID, and they may not get the valuation that they could have 6 months down the road after this whole pandemic scenario is, the dust is a bit more settled. So a debt option can, depending on what the debt product is, it can give you 2 months extra of runway, 3 months extra of runway, even 6 to 12 months extra of runway. So rather than taking a lower valuation earlier, if you know there's some milestones that can increase the company's value in the very near term, that could be a really easy way to help you extend your cash runway, hit those milestones, and get a larger valuation in that 3 months, in that 6 months, in that 12 months, which ultimately will help you keep a larger portion of your business. And when that, again, liquidity event happens or exit happens, what might seem like a small percentage today could turn into a really big result for the founder when that happens.
And let me just add to that. And I'm going to use very oversimplified math in this for everybody. But let's just say you need $100,000 to buy you a few months right now to run some inventory, to get some things going. And your two choices are debt at a 12% interest rate or equity. So if you choose equity, and let's just say at the end of the run, that $100,000 you traded away at the exit, the equivalent of 1% of your business. And you've had a great run, a very successful business, and you're exiting for $100 million. Well, that $100,000 worth of capital you brought into your business just cost you $1 million roughly. Now, if you had just serviced the debt and paid the interest on it within that year, it would have cost you $12,000. So that's why. I mean, that's just and again, that's a gross simplification of the math, but good enough for a podcast.
Inaccurate.
Yeah,
very accurate.
Yeah, roughly. But let's talk a little bit more in terms of when is the right time for brands to start having this discussion, because the folks that are going to be listening to this are at all stages, right? There are going to be some that are pre-revenue, and there are going to be some that are, now just starting maybe Series A or maybe post-Series A. But when do brands start thinking about debt, not just debt through Dwight Funding, but debt in general?
Yeah. So I think it's important to start thinking about financing in general pre-revenue. Right. And I think that if you start thinking about financing, the various forms of financing and how you obtain that financing, it really helps discipline the business finances and the business bookkeeping and all that kind of stuff on the way, because you're going to have to prepare to eventually show someone those books in order to get that capital. So you should start thinking about it. Always. You should always try to think about, okay, if I had to go get some capital now, would my books be in order? Would I be able to tell a good story about the business? And then in terms of when they should start thinking about debt in general, I think any time that there's a real cash need. Now, debt is not a one-size-fits-all product, just like financing isn't a one-size-fits-all product. So, let's say under the financing umbrella, you can do equity or you can do debt. So if there's a growth capital need, so you need dollars to spend on marketing, to build your brand, to build headcount, those are things that are going to return a long-term ROI on the business. Those are the things that you should be willing to give up a little bit more of the business for. So think equity for purposes like that. Now, if there are more short-term funding needs, whether it's because you need to purchase or you need help on production to fulfill a PO, a purchase order, or if you have just spent a bunch of money on inventory and you need some cash in the meantime to really smooth out your cash flow in order to manage your operational spend, or if you need to extend your runway a little bit, those are times that debt is really a good solution, where you're paying a little more interest. You're paying interest up front, but it's a shorter term need. So Elliot and I spoke a couple of days ago. I think it was last week now. Time is not a thing anymore.
All days just seem the same.
I know, no kidding. But we were talking about really understanding what your cash crunch need is and relying on advisors around you to figure out what the right product for that need is. So anytime there's a short-term working capital funding need, debt is a good solution.
And you made two, I think, really, really critical points here that I just want to reemphasize. The first is, your capital strategy should be just as important as your revenue and growth strategy. As you build your go-to-market strategy, you need to be building your long-term capital strategy. Because if you don't, it's like building a really, really amazing race car and then forgetting to think about the fuel that you need to put in it to get it down the track. So as you build your go-to-market, know the capital that's going to be necessary to fuel that growth. The second thing is the different use cases for debt versus equity. I mean, equity should really be growth building activities. It should really be the things that have a force multiplier effect on the business. For every dollar of equity that you bring into the business, you should have at least a path to 4x it in revenue in the near term, and it should be accretive revenue. Debt is really to finance the working of the business, the working capital needs. And one of the things that I say often, and those of you who listen to this episode probably are about to gag as I say it again, is that growth is the most voracious consumer of capital. So the faster your growth is, the faster your trajectory is, the more pressure that puts on your cash needs. And many brands right now are seeing that firsthand. They're having, really strong e-commerce growth, and their sales in brick and mortar on their core items are huge, but they're struggling because they did not foresee it from a cash perspective, and they didn't have that built into their business to absorb that type of incrementality when it comes to receivables and inventory needs. So it's very important to understand all the levers, and I'm glad you made that point. I'm going to ask you another question, but before I do, just a reminder that you can also please put your questions in and let us tackle those by just clicking on the Q&A icon. So let's talk about the different types and shapes and sizes that debt comes in. Let's tackle first the one that's probably least discussed as an option, which is venture debt. So can you explain a little bit about how venture debt works, and we'll work our way from there down some of the menu items on the debt a la carte item.
So I actually think of venture debt as a quasi equity debt solution. The reason I say that is because venture debt usually takes warrants in the business. So there is an equity component to it. It's a lot less than what a full priced equity round will be, but it does still take some ownership in the business. Venture debt is a really good solution for a business that has raised capital from a venture fund or a growth equity fund and wants to extend their runway. Think anywhere from 6 to 18, even 6 to 24 months. Venture debt can do that. 24 months is kind of long, but think 6 to 12 months. Venture debt can be a really good solution for that. Now, it makes sense that a venture debt group would want to take warrants in the business because they are taking a little bit of equity risk by lending to the business when the cash position is low and the company is not profitable, is burning cash day to day. So they are underwriting the business, very much relying upon who your equity providers are and the ability to raise again. So they're taking a bit more of equity risk. It's a little bit riskier. So the general structure of a venture debt product is in the form of a term loan. So you'll get one lump sum up front, and then generally speaking, you're going to have it may not amortize for the first year or for the first 6 months, but you'll generally be paying some interest on it, or at a minimum accumulating interest on it. It's something worth thinking about, whether or not that's the right product. If it's not that long-term need that you really need to plug your losses, and it is going towards that growth capital spend, that growth spend that's causing that burn in the business, but also allowing the business to grow quicker, for a couple reasons. One is, if you are amortizing debt when the company is not cash flowing, you're basically using what equity you have left to pay off your debt. Just a consideration. Further, as I mentioned, you'll be giving away a piece of the business as well. So, and again, it's not going to be as much as a price round from an equity group. And this ultimately can help you push off a raise to hit some more milestones in hopes to get a larger valuation 6 months down the road or 12 months down the road. So very well may be worth it for you. But those are just some things that are worth considering when thinking about venture debt.
So Jenny had a question about, about venture debt. Are there typically any major revenue floors for it? I mean, do you have to be at a certain size?
So that's a great question. Not necessarily. So I have seen some, and quite frankly, I've seen this a bit more in tech than I have in food and bev, and even like thinking food tech. The reason that there may not be huge revenue thresholds is because it's really reliant on who invested in you and when. The reason I say I've seen it in tech is because it's a bit more likely for a tech company to get pre-revenue funding than it is for a food and bev business, or at least from a big, like a known fund that's going to put a pretty substantial amount of money in there. So it can be pre-revenue. Now, with that said, that's a little less likely in the food and bev space. So I would say, generally speaking, it's going to be after Series A, sometimes even Series B, but depending on who's participating in that Series A, Series B. But if you have a large name venture capital fund behind you, or growth fund behind you, it's very likely that you could qualify for that venture debt.
And I will tell you, this is where being a critical consumer is so key. And this is where leaning into trusted advisors and attorneys and people in this space, because, you know, there's a lot of venture debt out there, and not all venture debt is created equal. So be very, very clear in terms of what it is that you're really doing or agreeing to. And we'll get to some more of that going forward. Jenny also says, by the way, hi, Jessica. So the next question is, or the next financing mechanism is, let's talk about factoring. Mm-hmm. So that's something that many brands try to do, factor their receivables. Maybe give those listening a bit of an explanation of the mechanics of that.
Yeah. So factoring actually can be a good solution for an earlier brand that may not qualify yet for an asset-based lending revolving line of credit. It's available for businesses that would qualify for that as well, but may not be the product of choice at that stage. So a factoring line, basically what it does is a factor, and when I say a factor, that is the lending company, they're your factor. They will purchase your invoices from you, invoice by invoice. So when the company is first starting, and maybe you get one big order and you fulfill that order, and then you have a big invoice for that order, that one order. A factor could be a good way to get paid on that order when you sell the product versus the 30, 60, or 90-day terms. There are a few considerations with factoring that are worth considering. Some pros, some cons. One of the benefits is obviously getting paid quicker. A second one, at that stage, when it's an earlier business, they do the collections for you. Now, this can be a positive and a negative, because a factor, they do so many collections that sometimes a collection approach may not be as friendly, or it's not always not friendly, but
Yeah, you send out Rocco to break a few kneecaps. We get it.
that's a matter of finding the right partner as well. But it's just important to know that there's another layer between you and your customer, you and your customer, because your customer essentially becomes their customer when you're selling them your invoice. So they're going to be doing the collection efforts for you, which just can sometimes be a little more aggressive than what you would have done yourself. Simultaneously, it tends to be a bit more expensive than what like a revolving line of credit would be. And by the way, there are levels of this. So there are some banks that do factoring, and they may not be all that expensive. And then there's some factors that will do like a one-off invoice here or a couple invoices here that are going to be a little more expensive, just because one, there is a back office that's doing all these collection efforts and keeping up with all the invoices and all that kind of stuff. But also they're lending smaller amounts at a time. So just, you know, to get over internal cost hurdles, et cetera, it tends to be a little more expensive.
And two things there to you know, again, just like in all things around everything that you do as a founder, but particularly around capital, choosing your partner wisely and choosing your partner that you know, that represents your, you know, core values is critical. And the second thing is when you're borrowing, when you're using debt, you have to understand the cost of that debt to the debt issuer. So, you know, when you take less debt, it's actually more expensive per dollar of debt than when you take more debt, because it's just the mechanisms. They still have all the same processing costs, all the same back of the house costs, all of those kind of things, but they're spreading that over fewer dollars. It's no different than, you know, the difference when you do a production run and you run the minimum versus running a, you know, full run in the production plant. You're going to definitely have a lower cost per unit when you run at scale. Same thing. So I want to make those 2 points out. One of the other things around factoring that I think is, again, to Jessica's kind of the good and the bad, is they're gonna, you know, if you use people who are in this space, who know this, they're gonna understand the dilution of the average invoice, so better than you are. So they're going to be able to say, oh, this invoice you just gave me that was for $3,000, you know, you're only going to collect $2,400 of it because of deductions and MCVs and so forth. So, you know, understanding that and having that conversation is key.
And by the way, Elliot, to that point, and to your point earlier, which about finding the right partner, which I actually could talk this whole hour about. It is, I really think it's incredibly important to work with a lender that understands the food and bev space, because speaking of dilution, unless you're in this space, you don't understand it and you don't expect it. And the last thing you want is a lender to expect that to happen and for it to happen that way, versus a lender that doesn't realize this is going to happen and sees that first payment come in that's only 70% of what the invoice was or 80% of what the invoice was, and then freak out. Last thing you want is your lender getting nervous. So I think
that's your job as a founder. You get nervous. Founders
right.
get nervous. Lenders shouldn't.
Right, but it's really important just to have a group that understands the nuances of the space you're in.
So let's talk about factoring's close cousin, and that's PO financing.
Yeah, so actually, I really like talking about PO financing, purchase order financing, because I talk to so
you're
many
just weird.
What's that? Because I'm weird. Yes, because there's something wrong.
That's what everyone wants to talk about, Jessica. Sure, it's PO financing.
Exactly. But no, I like talking about it because I feel like it's a little known secret, and specifically for earlier stage brands. So I talk to so many companies all the time, and it always amazes me when companies come to me for asset-based lending, which is lending on AR and lending on inventory, and the real need is actually purchase order lending. And there is a difference because purchase order lending comes before the inventory happens and it comes before the AR happens. So anytime a business has, anytime, I'll just keep going. Anytime a business has a purchase order from a large customer, whether it's, a food and beverage distributor or a retailer, an individual retailer, most of the retailers and all of the distributors right now have great credit quality. So a purchase order lender, generally speaking, is going to see this purchase order from a UNFI, or let's just say Whole Foods. Maybe Whole Foods is giving it to you direct. And they're going to say, yeah, we're happy to help you produce this. We will actually pay for your production. Whole Foods will then pay them, and they will pay the balance once their whatever's owed to them is paid down. They'll pay the balance back to the company. But it puts businesses in a position that they don't have to say no to those big orders. So last thing you want to do when you're scaling is get an order from a UNFI or a Kroger or whatever and have to say no because you don't have the cash to produce it. So I think that I think purchase order lending is a really, really good option for younger brands. Now, as a brand begins to scale and they're of the size that an asset-based lender might want to jump in and provide a more fulsome product, even if they're not a purchase order lender, if you have the right partner, they may step up and help here and there on purchase orders as well. So, but it's a really good starting point when you get that first new order and you just need help on the production side.
So another question here was, what are the differences in percentage points on average between PO and invoice factoring?
That's a good question. So something to consider about purchase order lending is there's an added level of risk. So bringing this back to like finance 101, right? The more risk there is, the more the larger return the investor or lender is going to want to receive because of that risk that they're taking. So when you're talking about purchase order lending, there's an added level of production risk. What happens if they pay that co-packer or that co-man to do this production run and something goes wrong and the product doesn't come out the way it was supposed to and UNFI doesn't accept that product? They're out of that money. So that's going to be a bit more expensive. In terms of points, it just really, there's such a large range between various lenders and their particular product. But I will say, getting purchase order lending, you should expect to pay a premium. And quite frankly, taking on that risk, that lender probably rightfully should expect a little bit more return for that. Whereas lending on the invoice for a product that's already been sold, final sale to a UNFI is going to pay because they already got that product. Might be less some discounts, some spoilage, some some slotting, all that kind of stuff, but they're going to pay. So it's a little less risky for the lender. Therefore, generally speaking, they're going to require less of a return.
And one of the things that I think is really important when you look at debt financing, options is that it's not always the lowest cost option that wins the day. It has to do with, a lot with not only the partnership and all the stuff that we've talked about, but also the flexibility and the ability to transact the business the way you want to. So, for example, PO financing gives you the money sooner because now you have that money in advance, depending on your order lead time, maybe 3-4 weeks earlier than you would have if you did it only as invoice financing. And you can use that to build your inventory or to finance some of that inventory. So a lot of it has to do with the way you're going to use money. And that's why it's just so key in general to have a real capital strategy, not just the typical, I'm going to get on the hamster wheel and go out and raise capital, but why am I raising capital? What am I using it for? How is it fueling my business? What is the best, what gives me the most inherent flexibility and so forth?
Yeah.
Go ahead.
Sorry. Yeah, Elliot, to that point, opportunity costs. What if you do say no to that order? What are you losing on in the future? Are you losing the opportunity for a bigger purchase order going forward, or more doors, or an entire region, or a nationwide distribution? What are you losing if you have to say no to that? And then think about, realistically, if you're talking about a couple points difference in a product, it's likely immaterial, the actual dollar amount that couple of points equates to, just to have that money a little bit earlier and not have to say no to that order that could lead to more orders.
So Denise has a question here, and that is, do they also take into consideration with PO lending if the PO might get canceled?
Yes. So if the PO gets canceled, they still have to get paid back, right? So if they've already put the money into production, they still have to get paid. They still have to get paid back. So they're gonna, first and foremost, they're gonna do their diligence on the front end to make sure this is a pretty solid purchase order. But even if it doesn't come through that particular purchase, they are gonna want to get paid back. It'll have to be through future sales, or if the funds are available in the company, today, through those, but they are gonna wanna get paid back.
So going back to factoring, here's another question, this one from Jenny again, and that is addressing deductions. How do you address a deductions from a UNFI with a factoring partner?
Yeah. So generally speaking, and I can speak to, so my group isn't a factor. My group is in asset-based lender. So the difference, and I'm kind of switching a little bit, but I'll explain.
We're going to get there for sure.
Okay. But so we lend a percentage on a consolidated amount of AR. The way that we account for it is we actually account that percentage on the company's net AR. So when we're evaluating the business, we're going to look back and say, hey, what is this company's typical dilution? And then if we're giving them a percentage on the AR, it's going to be net of that dilution. It's going to be similar with an invoice only lender. Now, this is where it's important, I think, to work with a company that understands the food and bev space, because if a factor says, I am going to lend you 85% against your invoice, and then they're waiting to get payment, but they actually only receive 80% back because of 20% dilution, they're going to freak out. They're going to start knocking on your door for that additional 5% plus their fees. And it's just going to be a hassle for you. You might get away with it once, but that benefit won't be worth, the reward won't be worth the headache that it causes. So it's just better to work with a group that really understands that dilution is a fact of a growth stage business in this space, and anticipate it and lend on a number that's net of that dilution number.
Yeah, and two things here. One is just to because it's interesting that from a lender perspective, they use the word dilution, but from a brand and founder perspective, we tend to call it deductions. Same thing. I just want to make sure everyone's clear on that. But that is, I agree. That's why you want to work with a factor or with a lender in general that understands the space. In addition, I have known factors to go to their brands and saying, your dilution / deductions are way above the industry norm, and here's some best practices, and actually become, valuable assistance in helping reduce, and manage deductions, because they have visibility if they're in that space and they're doing hundreds of companies that are selling to that same distributor, and in the same kind of categories, they have that benefit. So Jessica, let's get to asset-based lending and asset-based revolving credit. And let's talk about that solution first in kind of a general, and then I want to get into a little bit more specifics on how it actually works and transacts, because I think that would be very educational for those listening.
Sure. So asset-based lending, revolving line of credit. I would say that the best use case for an asset-based lending revolving line of credit is to smooth out your cash flows. Smooth out the cash in your bank account. So we all know this is a capital intensive business, right? You are constantly buying inventory, you're constantly manufacturing, you are selling to distributors and retailers that aren't going to pay for 30, 60, 90 days. So what do you do? How do you pay for your operations in the meantime? An asset-based lending revolving line of credit really solves for that problem. So, you know, generally speaking, there's X percent that's getting lent on your AR and X percent that's getting lent on what inventory you have on hand. So what that prevents is, let's just put it in the form of an inventory purchase. So if you purchase, let's just say $100,000 in inventory, that money is out the door and that inventory is now sitting in your warehouse waiting to get sold. So then what? Like, how do you're now $100,000 out on your bank account. So an asset-based lending line will say, okay, you have this inventory on hand. We're going to give you a percentage of cash up front for that inventory that you hold. That way you can still manage your operations. Same exact thing really with the AR. You get a larger percentage on the AR. Reason being is that, again, going back to that risk profile, once you've already sold that inventory and you're just waiting to get paid, it's a little less risky to lend on, so you can get a bigger percentage, et cetera. But same exact thing. So when that inventory then converts into accounts receivable because it's been sold, you still haven't recovered that $100,000 that you spent on the inventory initially. You're still waiting to get paid. So an asset-based lending revolving line of credit can take you from that inventory all the way to when it turns into AR and really supplement that cash that you've lost along the way, so that your operational spend is never challenged, and it's just really your cash in the bank is really smoothed out.
So one of the things that I always try to preach, some will say pontificate, is the importance of really understanding your cash flow at a detailed level, and really doing the work yourself of at least a monthly, if not weekly, if not daily cash flow. And one of the things you'll find if you do that with regularity is that there are going to be periods in any term or in any year where you're going to have cash, what I call cash cliffs. You're just going to have situations where, to put a very technical term on it, you're going to have an oh shit moment and recognize, I won't have enough money in the bank here to float the business, even if the business is doing well. And one of the great purposes of having an asset-based lending revolving line of credit, by the way, say that 10 times fast on a podcast, I dare you. You smooth out those cliffs. You don't have them. You don't have those oh shit moments. And I think that is vital for a business, and it's vital for a good capital strategy. So let's talk specifically how the mechanics of that work. So let's say that I'm working with you, Jessica, and I'm onboarding, and tell me how it works kind of soup to nuts so I understand the actual process.
Yeah. So generally speaking, any non-bank asset-based lender, which is what Dwight Funding is, if you're not getting that asset-based lending line from a bank, which generally speaking for a growth stage business is tough, also may not necessarily be the right solutions because it's not as flexible as a non-bank lender would be. But all of us non-bank lenders use what's called a lockbox. And Elliot, if it seems like I'm getting too deep into the weeds, let me know. You go.
I'll pull you back up if need be.
Okay. All right. So they use what's called a lockbox. The way that works is there is an account in asset-based lender's name. The way that it works is, let's just say you have $100,000 of AR. We will generally, the typical advance rate for AR against AR is 80 to 85%. More frequently than not, 85%. So if you have $100,000 in AR, and asset-based lender X is lending you 85%, we're going to give you $85,000 upfront as you wait to collect on those receivables. When those receivables are collected, they flow into asset-based lender X's bank account, which is the lockbox. What happens then is that 85% of the $100,000 that was collected is used to pay your balance down to zero, and the additional 15% flows through to your business. Now, that's how it happens technically. In practice, the idea is that you then have sold another $100,000 in product. So you have an $85,000 balance, you've collected $100K in receivables, and you have another $100K in receivables or more that you can then borrow 85% on again. So as long as you have the AR to support 85% in borrowing, or to support the 85,000 in borrowing, we can then just take all the funds that were collected in that lockbox and flow them through to the business. Now, what's revolving about it is, in addition to the cash revolving, is if
and
that—
my head revolving, just throwing that in there too.
What's that?
And my head revolving around.
Okay, so you're pulling me back. You're pulling me back.
No, I'm kidding.
But the idea is that whatever AR you have or whatever inventory is being stored, you're just getting that cash up front. As long as you have the asset level needed to cover whatever your advance rate is, then you can maintain that balance. And all the funds that flow into the lockbox just flow right through to the company. Now, as that 100K turns into 200K, you can now borrow 85% of 200K. So it's really good for a scaling brand, because as top line grows, your assets obviously grow as well. So your AR is going to be larger. You're going to need more inventory, and you're going to automatically have more availability because that 85% remains consistent, but your assets grow. So the 85% number brings a larger dollar amount to the business for borrowing capabilities.
And how often is this trued up? I mean, is it truly transaction by transaction, month by month, or do you look at it with your founders and their teams quarterly, monthly?
Yeah.
How do you assess that? How do you assess what they have access to?
Most groups require that it's done monthly. Most clients want it done weekly because that lockbox is collecting all the incoming receipts. So for that lockbox to hold all those receipts until you free up those funds again and do a new recalibrate, it's a long time. So most of our clients want to do it weekly so that the funds flow more frequently from the lockbox to the business.
And what is, not just for Dwight funding, but in just kind of looking at ABL in general, the range in terms of, I mean, come knocking on my door when you have what in these kind of assets and in receivables, et cetera.
Yeah. So it's going to vary depending on the asset-based lender you're talking to. Like if it's a bank asset-based lender, you're going to want to be certainly more mature than what a non-bank lender would want. So I would say, generally speaking, you're going to want to be definitely north of $1 million in annual sales, if not, 2 to 3 million in annual sales. And I would say run rate. Bless you.
Thank you.
You're welcome. Sorry, I called you out. You muted yourself. And
I did. I thought I was going to be covered.
I would say, so an asset-based lender typically wants to see proof of concept. But also they definitely want to see some history, proof of concept, which, tends to be around the 1-2 million in annual sales range. But they also want to see tightened up financials and tightened up books. So, going back to what Elliot and I were saying earlier about, just not putting these thoughts and these the thoughts about getting financing on the back burner. Don't make sure you're always keeping your finances top of mind and buttoned up, because that will be a requirement.
Yeah. And I'm going to ask you one more question specifically on this, and then I want to switch to one other topic. And then also there's another question here, and that question is, you know, how long do you typically have a relationship with one of your clients, one of your brands?
Yeah. So, asset-based lenders tend to have terms anywhere, typically like 2 to 3 years, anywhere from 1 to 3, but more frequently than not, 2 to 3. And it depends on the asset-based lender. So we tend to have relationships with our clients until one of two things happens. One is there's an acquisition, which is awesome and a really great success story and always fun to be a part of. Or two, the business becomes such steady state that the flexibility is no longer really needed. And in which case, at that time, bank lending makes more sense, because a lot of the non-bank lending benefits are the flexibility, less covenants, things like that. And a covenant, just, you know, for anybody watching, is it's a measurement of the business, and there's various measurements. Like some will be EBITDA covenants, which are hard to hit as a growing CPG brand. So a bank just might not make sense for that reason. Also, there's regulation, and there's just a lot of lending parameters for a bank, whereas a non-bank lender, as the business is scaling, requires a little more flexibility and may want some out-of-the-box solutions from their lender. A non-bank lender is the right solution. But the time that the company has scaled and the company is really at a steady state, their projections, they know they're going to hit, they're not worried about the EBITDA covenants, that could be a really good time for bank funding, where it's less expensive, but you're giving up the flexibility. So also a success story. So depends on the business, depends on how early they start with us, how long they scale with us. Our clients are generally staying with us anywhere from 4 to 6 years, as long as, or longer if they'd like to, but generally one of those two things are happening at some point along that road.
So long enough that you guys develop really a pretty meaningful relationship. It's not a transactional one. It's
at all.
Okay.
Yeah, we are certainly, Dwight, we are absolutely a relationship-based lender. So like we're not a volume lender where we just want to get as much money out as we can. We want to work with companies that we can really be a part of the value add and a part of the growth story. That way everybody around the table has a really good experience.
So we've got 2 more questions here in the Q&A, and then I want to make sure we have time for an exploration of another topic. So this one is, how does shelf life of inventory factor into, inventory financing, PO financing, et cetera?
Majorly. So it won't factor into PO financing necessarily, because they're helping on the production end, but the idea is that that's going to immediately be sold. When you're talking about an inventory advance, it matters a lot. The reason for that, an asset-based lender ultimately can get comfortable lending against your assets before like a bank or something like that would, because there's value in those assets. So, and this is going to be a morbid way of thinking about it, but in a worst case scenario situation, how would that lender recover their principal if they needed to? If a company's lending, if a lender is lending on inventory and that inventory has a short shelf life and something happens with the business, then they would want to go to your 3PL or go into your warehouse and recoup that inventory so they can sell it off in hopes to get their principal. The fear with a product that has a short shelf life or just is perishable is that they go to the warehouse, or they go to the 3PL and it's nearing its expiration date. It's not past it, or the product only lasts 3 or 4 days and that product no longer has any value for that lender to recover any funds or any principal. So it matters a lot. For example, and again, this is just talking about Dwight, a milk product may be tougher to lend on than a snack product that has an 18-month shelf life. If hopefully that answered your question.
That makes a lot of sense. And so you would either devalue the value of that inventory or lend on a lower percentage of it.
That's exactly right.
Or charge a higher percentage fee, or yes to all the above as necessary. Not just you, Dwight, but I mean, that's how a lender would have to look at it because it's
right.
increased risk.
That's right.
Then another question here is ABL such as Dwight a good match for a firm with low sales, a good concept with much intellectual capital?
It's a tough one. The younger the business, we'd have to figure out, I'd have to dig in to understand what that intellectual capital is. If you're talking about just IP, the younger the business, and I mean IP in terms of like brand value, et cetera, the younger the business, the harder there is to establish value around that. So that's what I would say initially around that. There are groups that do that, few and far between, but generally it's expensive and it has to be a bit more of a mature business.
I want to leave time for this conversation. So about 5 minutes here to talk the watch outs and the things that people have to really understand what they're agreeing to. And that would include things like personal guarantees and validity guarantees. It would be signals that maybe what they're being asked to do or getting themselves involved with could be predatory. What are some of the things that you would just tell those listening? Because, the earlier you are in your journey, the more at risk you are in terms of falling victim or talk in, and it's not even that, it's even talking yourself into it. I heard from a founder recently who sold their house to finance their business. I mean, those things are personal choices, but personal choices should be always informed choices. So,
absolutely.
What would you counsel people?
Yeah. So one thing that, Elliot, I'm touching on something you mentioned earlier when we were talking about venture debt, and that not all venture debt groups are created equal. Sometimes there are milestones put into place in the form of covenants that are hefty milestones. And I think that it's important to recognize that what makes a growing brand scale and exciting and like take off, has a lot to do with the entrepreneur and the entrepreneur mindset. Of believing in their business and believing in their product and believing in their mission. But I think that when you are committing to a lender to hit certain milestones that seem like they could be, like they're attainable maybe, it's important to recognize that things happen. When you're growing a business, things happen. Like nobody had a crystal ball to COVID, right? And that happened. And there were businesses that were affected by that, by no fault of their own. So I would just say before committing to any sort of forward-looking covenants that require certain revenue milestones or certain EBITDA milestones or EBITDA improvements or anything like that, just talk to advisors, talk to the people around the table. Just be wary of doing that at this stage, I would say. Covenants in general, because they can be hindering, and things happen. And I am saying that from a place of somebody that looks at a lot of financials and talks to a lot of businesses and looks at a lot of projections. And I can say definitively more times than not, projections aren't hit. Just be wary of that. Be wary of locking yourself into too much forward looking. Another thing I would say is, and we've touched on this many times, but I seriously cannot express it enough, find the right partner. having the right partner by your side, and any business owner would do the same when it comes to finding your advisor, choosing the equity group you work with. The same goes for debt. Find the group that is a fit for the company's ethos, the executive team's personalities, the vision going forward, and find the group that is going to be with you along the way. And really, I mentioned before, being a part of the growth story, that's going to really do that and contribute to the business's growth, both in terms of revenue, but also just in terms of network, in terms of the way you think about things, whatever. Find the right partner. And I would add there, when you are looking for debt or financing in general, I think one of the most important questions that you can ask is, how has this debt provider, how have they behaved when a company in their portfolio didn't do well, or hit some sort of speed bump, or had some sort of challenge that they faced that could have affected their loan or their or whatever at that particular period of time. Do your diligence, because again, to Elliot's point, not all debt providers are created equal. And
I'll just add to that. I mean, a few things. First of all, I think every founder who is deeply, passionate and believes fully in their project should have a pessimistic, cynical, contrarian best friend.
Mm-hmm.
Not that you necessarily want to hang out with that person all the time, and nor do you believe necessarily that person's always right. But it's really beneficial to have somebody who is going to try to point out the what ifs, and make sure that you're seeing things maybe through less rose-colored glasses. The other thing that I would tell you is that this is what I see founders do far too often, is they get to the point of desperation and then they're trying to make decisions. Mm-hmm. When your business is not in the throes of that moment of desperation, when you're not standing by the precipice of a financial cliff, a really good exercise to do is to write down your no's, to establish your guardrails. Like, I won't sign a personal guarantee, or I won't spend, I won't be in debt beyond this. I mean, what are your no's, and have those, so that when you do come to that precipice, which almost every business does at some point, you have that thing, that guardrail, that reminder of what you said and set out that you wouldn't do. Because listen, what you're choosing to do in this space is hard, and even the best of partners, can't stop you and can't slow down your passion. And what you do want to do is that if you happen to struggle or fail, which I hate to use the word fail, it's because I think failure is inaction, not action. But if your business doesn't survive, what you don't want it to do is follow you around like bad luggage for the rest of your life. You want to be able to take a deep breath and regroup and move forward. So I'll leave that kind of as the parting thoughts. And before we sign off, and I said this at the onset, and I'll say it again. Although, I mean, I would love to give Jessica shit. I really can't here. She is truly, truly one of the most generous people around financing with her time. She gives you, no BS, straight shooting answers. Half the people that I send her way to talk aren't necessarily even ready or right for Dwight. But she always takes the time to talk with them, coach them, and give them really good feedback. So I'm going to put her on the spot here, but how do people reach out to you or find you if they want to learn more about you, more about Dwight Funding, or for any other reason?
Yeah. So first of all, thank you, Elliot. That was very, very kind. Yeah, look, I'm happy to talk to anybody. Anything I can do to contribute. Dwight, in general, like however we can contribute to the ecosystem, we're happy to. You're more than welcome to. I'll give, Elliot has all my information, so if anybody wants to reach out to him for it, they can. If you want to reach out on LinkedIn, feel free. I am happy to make time just for a conversation. As I mentioned, I like talking jet. Why? Who knows? But I do.
Most people admit publicly, but that's okay.
I know, it's sad. But no, really, I'm happy to help in any way that I can. So feel free to find me, ask Elliot for my information, look me up on LinkedIn.
And we'll put the link to your LinkedIn profile and to Dwight Funny's webpage in the show notes so people have access to it.
Yeah, so you can, if you want to put my email, you can put my email as well, whatever makes sense.
Be careful what you wish for. I will. Thanks everyone for joining. I hope everyone has a terrific rest of the day. Our next episode is going to be another one of our pitch sprints. Super cool. So we're going to be joined by 3 brands, Amazi, Real Cocoa, and Fluid Cold Brew. And we're also going to have a pretty cool panel of investors. So we'll have Nick McCoy of Whipstitch Capital, and we'll also have the team from Echo Capital, Stephen, Sabrina, and Ben. And what we'll do is each brand will have 5 minutes to pitch and a little Q&A. But then the really cool thing happens is you get to see what happens in the room after the founders leave. What do investors really say about the pitches they've just witnessed? What do they wish they heard, wish they didn't hear, want to know more of? What do they feel like maybe the founders missed? And the hope is that it's a great, educational opportunity, not only for the 3 brands pitching, but for all of those who witness either through the podcast or come to the live event, that interaction and what investors are looking for. And hopefully that helps tailor future pitches and future investor conversations. So join if you can, and that'll be next Tuesday at 10 a.m. So with that, Jessica, thanks so much. Everybody have a great day.
Thanks, everyone.
Talk soon. Bye-bye.
Bye.